I just wanted to explain a little bit of stock market terminology. So the first thing to understand is that stocks are a small piece of ownership in a company. So they're also referred to as equities, and you can buy and sell stocks throughout the trading day. You make money by earning a dividend, which would be a regular payout of earnings from the company to its owners, which you would be part of their owners if you owned their stocks. You can also make money on it by selling the stock at a higher price than you paid for it, so getting a capital gain. Bonds are money that you loan to someone else, like a company or a government. So you loan them money and then they pay you interest for that loan. Bonds are also referred to as fixed income or fixed income securities. And of course, you make money because they're going to pay interest to you. And often they pay that interest once or twice per year on a fixed schedule. Reits are real estate investment trusts. They are companies that own or finance income-producing real estate, such as retail, residential, healthcare, office buildings, and mortgages. Reits are required to pay out 90% of their taxable income to shareholders. So you make money primarily on Reits through a large dividend payout, but also you can make money through capital gains. Something to know is that the dividends through Reits are largely unqualified, which means you pay a higher tax rate on the REIT dividend than you would on some other dividends. So it's ideal to put REITs inside of a retirement account versus inside of a taxable brokerage account. Mutual funds. So mutual funds are a pool of investments. So you can own a small part of many things at the same time. It's kind of like not putting all of your eggs in one basket kind of thing. You own a small part of many, 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 many companies. It helps you to diversify, which helps you to reduce your risk. You can buy and sell shares of a mutual fund once per day at the daily rate that is chosen after the markets close. And so you would put in your order during the day, and then overnight your purchase would go through. You earn money on mutual funds the same way that you earn money on the underlying assets. So depending on what's in that mutual fund, it would be primarily capital appreciation and dividends for stocks, primarily interest payments for bonds, and primarily dividends for REITs. A managed fund is a type of mutual fund where one or more managers is trying to beat the benchmark index by actively buying and selling companies within that index. So it's also referred to as actively managed, and you pay that professional manager by the expense ratio, which is a portion of the money that you invest. So if the expense ratio is 2%, then 2% of however much you are holding in that account would go to the fund manager. Managed funds typically have expense ratios of 0.3% to 3%. Index funds are a type of mutual fund that passively tracks the entire benchmark index rather than picking and choosing from within it. So you would own a small amount of every single company in that index, and an index could be, say, the S&P 500 index or small companies in the United States or something like that. And you're not just picking and choosing companies, you're just getting all of them, usually in the proportion of kind of their share of the stock market. Index funds are also referred to as passively managed, and it really reduces the expense ratio. So the expense ratio is usually between 0 and 0.3% on an index fund. They are bought and sold just like a mutual fund because they are a type of mutual fund. Often, though, people will specify something is a mutual fund and something else is an index fund. But really, an index fund is a type of mutual fund. Though usually if you hear the word mutual fund, probably they're talking about a managed mutual fund. An ETF is also called an exchange-traded fund. It's similar to a mutual fund because it's a basket of, you have a very small amount of a whole bunch of different things. However, it is bought and sold like a stock, not like a mutual fund. So instead of being traded just once during the day, it's actually bought and sold all throughout the trading day, just like you would a stock. So the price goes up and down throughout the trading day as well. Often ETFs are passively managed and based on the index, but sometimes they're actively managed. I know Fidelity lately has had some more actively managed funds. So you're always going to look to see if it says the word index in it, or you're going to look at the expense ratio to try to get an idea of whether it's an actively managed ETF or a passively managed ETF.